Well, Ridham's here, so let me just quickly start the conversation. Ridham, it's great to be here. You are dressed differently. You're celebrating the Indianness of this conference.
Yeah, well, I think it's high time we move to our own attire.
Okay. Now, broadly, if I look at the market setup right now, it's been a good May. It's been a okay June. Do you think that large part of the one-time re-rating which we saw because of the election mandate, that's behind us?
Yeah, I think so. I think it's largely done. The election results surprised everybody on the upside. I don't think people thought that we'll get a majority government of this size, and that warranted some move in the market, and I think it's mostly done. For the next leg, I think you need more triggers now. You need policy action from the government. I think there are two things that will drive this market. One is, of course, how growth rolls out in the second half, on which we are constructive. And the second is, what policy choices the government makes, which I don't know right now. I can put out my wish list, but I'm not sure what exactly they're going to prioritize. So that, I think, are the two things that the market will pay attention to. And on the side, there is the global thing, which is not looking so pretty. So if there's any disappointment on the domestic front, I think the market will quickly react to poor global cues. For now, at least, I think the market is holding out hope that we'll get good domestic cues. So the global stuff is not mattering, apart from maybe a day-to-day basis, but not much mattering to the trend.
Are investors breathing a sigh of relief after the mandate, or they're happy and excited about the next 5 years in policy making?
So given what was priced into the market going into the elections, I think it's more like a sigh of relief. Essentially, the biggest takeaway is that it means that there's certainty of policy. So, from Google Trends, for the past few years, we've been picking up something called the Policy Uncertainty Index. So Google actually uses big data to basically eke out this index, and it does it for many countries. And we plot India's policy uncertainty relative to the world. Okay. And that is at all-time highs, even going into the elections. And my view was that it will start rolling over, but it won't now. Because I think the biggest takeaway from this election result is that we have an administration which was already in office, and therefore has its agenda pretty clear. And from what I understand, Delhi did not actually shut down during election time, because the bureaucrats were told by the Prime Minister that I'm coming back, so work continued. And therefore I think a lot of policy is in the works. I don't know which exact policies are in the works, but a lot of policy work has been going on in the background during the months of March, April, May, when usually things kind of wane. So that is the biggest advantage that the market has, that there's some predictability. Like, for example, we know the inflation framework will not be altered. So we're in this benign inflation environment. The BJP-led NDA is not prone to increasing minimum support prices and has not succumbed to that tactic, because triggering food inflation, while it may seem to support farm incomes, usually creates generalized inflation, and then it gets bad for everybody, including the farmers. So it's not a good strategy. So we know that they will not do that. We know, for example, that they are ultra focused on infrastructure. So that's not going to change. And we've already seen a slew of announcements on how they will boost it. And in fact, their manifesto says $1.4 trillion over the next 5 years. Maybe that's ambitious, and it's good to have an ambitious target, but if we get to 10% of GDP in the next 3 years, I think it will be a great outcome. Can I rely on that as a possibility? I can, because I have a track record. So, some things like these, the market can easily say, I can forecast this is going to happen. Of course, there is a whole new set of policies that need to be launched, and that, I think, is what we will wait for.
Okay. Now, before you throw data at me, we've looked at some data, which is that if I look at what markets did during NDA-1 regime, they pretty much have managed to map global markets.
Yeah.
We got a powerful mandate, crude prices were benign, we had strong foreign flows, yet Indian markets were simply aligning to global markets, plus or minus 5% depending on the data point. So irrespective of what the mandate is, do you think we should be very cognizant of the global reality, and the global reality is not great, like you said?
No, so I think Nikunj, we outperformed in what was a pretty challenging macro environment for India, where we could not generate earnings. I mean, my throat is dried calling an earnings cycle. and it's not coming to us. And a lot of the factors I thought that would help an earnings cycle really did not pan out for one reason or the other. Now in hindsight I can explain all this, but that was not the foresight I had. So I think you have to put it in context that we still had the bid on the market despite the fact that we disappointed on macro growth.
That's a great
so
point.
if you look at just to extend that point slightly, we underperform emerging markets on earnings. We dramatically underperform the SPX on earnings, but we did not underperform on share prices. So what it means is that the market is of the belief that the earnings cycle is at its doorstep, and to some extent I think the next 12 months earnings growth is already priced in. It has to surprise on the upside. A 20% number is kind of baked in the cake. That's not going to do magic for the market. I mean, it may still retain its bid, but it's not going to make big new highs with a 20% number. That 20% number has to then get repeated in the following 12 months. And I dare say that the market is not priced in a new growth cycle, but kind of believes that there is some growth recovery in the next 12 months.
Which are the factors which, according to you, are at play, which are in a sense convincing you that we have dawned on a new growth cycle? And what do you think this time is going to be different in next 12 to 18 months, which is making you optimistic? Because your research reports are indicating that you have one of the most optimistic view on the street.
Okay, I don't know about the relative comparison to the street, but here are the factors. So firstly, I think we have capped the inflation genie in the bottle. I think that's not coming out in a hurry. Even rising oil prices did not upset it. So we have achieved a lot. I think we must pay attention to that. It's the combined effort of the central bank and the government. The second is, I think the government has spent counter-cyclically by boosting infrastructure spending. And that's not just the government in Delhi. Lots of state governments have participated in that. Third is, I think we have successfully executed on Aadhaar DBT. This is a sea change for India. In fact, I think most people underappreciate what this means for the Indian economy. And we don't have time to actually delve into it. It's a whole program for me to talk about Aadhaar DBT and what it means for the next 10 years for India. But in summary, it basically sets us up for the first time in our history to induce fairness in a capitalist model. Okay, so we can now safely transfer resources to the poorer sections of society who are disadvantaged because of bad, if I may use the word, luck, and bring them up, in the income curve. That is in place. Then we have had a fair bit of fiscal consolidation. So it's not like we went into the down cycle and the government exhausted its fiscal capacity. It didn't. So it's retained that. So we have now at least made sure that the state-owned banks have got enough capital to survive Basel III. They don't have enough capital for growth, but they are surviving Basel III. We've put GST in place, which has been painful. But I think most of the pain is behind us, and I think you will see that uptick in GST revenues because it has now fully being implemented. And to some extent, we have taken pain. Some extent, I don't think fully. We've taken the pain of formalizing this economy, because of the manner in which this economy transacted in the past, and now the way it's transacting, it was very painful. And I think GST plus the formalization explain all these growth pangs of the last 2 or 3 years. So you set that base up, and we have profit share in GDP, which is at all-time lows. So I think it begs a view that we're going to turn. The timing is not very easy to point out, but I think it ought to happen. And we saw the signals in this quarter. The banks will lead the way. They were the ones that led the way down. They are leading the way up, and the banks are doing okay now. So I think the banks will probably continue to print good earnings, and that's what's going to drive the Nifty earnings. So 20% I think is something that we should now hope for and expect over the next 3-4 years.
But long corporate banks, do you think both in terms of positioning and also in terms of ownership is not a crowded trade? Because that's like the pretty girl in the town, and everybody wants to be with that pretty girl.
Yeah, so Nikunj, ownership does not have any predictive power on share prices. Okay, it only predicts share prices when something else goes wrong. So using that as an isolated metric to say, oh, this stock is overowned, and what is overowned? Overowned versus what? Overowned by whom? Why do we distinguish institutional investors from retail? right? Or why do we distinguish foreign portfolio investors from domestic? So overowned by whom? So yeah, institutional ownership in say a corporate bank is say 65%. Is that overowned, underowned? You know, that's I think a kind of it's a faulty argument unless you have other things going with you, which is that, oh, the earnings are going to come bad, or you know, something else is going to happen, and then, you know, because there are too many institutions sitting in the stock falls. So ownership I am not worried about. I would pay attention only to valuations and earnings, and so far as the valuations are okay as they're benign right now, and the earnings are coming through, I think the stocks will continue to do well.
Everybody is talking about the slowdown. Some are feeling the slowdown, and some are disappointed with the way how things are moving for the economy. How does one understand the slowdown is cyclical and it is not structural?
I think that's always a hard conundrum to break, but I would imagine that this slowdown, in fact the economy was doing fine until the middle of next year. We were actually coming out of the slow patch post-demon. The INFS issue, I think, really caused a problem because that was not anticipated by anybody. The auto companies especially did not see the slowdown in consumption because of slower financing by the NBFCs in the aftermath of INFS, and as a consequence I think inventory got piled up, which meant that they had to cut production. So that was the first thing. The second thing is we went into this election factor. So you can see that in 2014 also, elections caused a slowdown in consumption because of the cash that gets flooded into the marketplace. The government spending slows down, so its balances with the RBI swell, which again puts kind of a lid on the economy. So that's the second thing that happened. Third thing is that there has been a perceptible slowdown in global growth. And now the numbers are coming. So our export growth actually slowed down, and it slowed down materially. So now imagine three engines, you know, shut down. Financing for the consumer, election-related slowdown in monetary growth, and you had a export thing. And now on top of this, there was an RBI that was transitioning policy. So until December, the RBI was distinctly hawkish, was still fighting the inflation battle, persistently overestimated inflation, and that was a consequence of the newfound mandate that the RBI had in 2015, which is inflation had to be pegged. So you can't blame the RBI. If I'm given a single mandate that this is what I have to achieve, I'm going to put all my energies to achieving that, even if it means I sacrifice growth. So that did happen, and it was only in February that the RBI said, you know, now we have put the inflation genie in the bottle, we'll pay some attention to growth. So the RBI started providing more liquidity. All that has been work in progress. So to some extent, I think we had overall monetary tightness in the system, which is now easing. So I reckon it's cyclical, it's not structural, and a lot of these factors are now behind us. I think the inventory adjustment in the auto sector is mostly done. Elections are mostly done. Come July, the government will start fresh spending. The RBI has clearly taken the foot off the pedal, and in fact I would say it's distinctly dovish, and multiple actions from the RBI suggest that. And I think you know, therefore the economy should actually come out of this patch in the next few months. I think even the NBFC problem has probably seen its peak. Now a few NBFCs continue to be in trouble, and I think they'll fall by the wayside, and it's good. For example, I don't think that there's any need to panic that a couple of NBFCs are struggling to survive. It's the nature of business. You know, a few people do fail along the way, and it's okay to let them fail. We don't need to engineer something to, you know, make everybody survive in business.
10 years ago, if you would have made a case that ADA group of stocks will go, ADA group of businesses will go belly up, that would have created a panic. 2 years ago, if you would have made a case that some NBFCs could go belly up, it would have created panic. But do you think by and large at the current juncture, markets are pricing in that one or two NBFCs will fall flat?
So, you know, just step back, and we didn't bring this up in my discussion when you asked why do I think the growth cycle is tough, because another pain that we took, a couple of other pains that we took in the last 3 years was RERA and IBC. Yeah. These are not, these are not run-of-the-mill reforms. They are structural in nature. They change the way business is done. For the first time, there's a threat on an Indian businessman that if he does not pay his or her interest, his company can be taken over and sold. And this is a very big change. So I think we are seeing that now bear out in the marketplace, which is either people are, who are feigning liquidity or solvency issues have to react, or those who are in real trouble are going to fall by the wayside. It didn't happen in the old India. In the old India, everybody came together to make sure that people survived. And that was not optimum utilization of capital. So one of the calls that we have is that coming out of IBC, return on capital in India will improve, because bad capital allocation will get flushed out of the marketplace quickly. And I think IBC is still work in progress. It's not completely stabilized. The laws are still being framed. The courts are still delivering verdict. But a fair bit of work is behind us. I would say 90% is done. And this is, a good thing. It's not a bad thing. It's what has made America such a great market, because bad businesses get flushed out. We in this country for years have been supporting bad businesses for the fear of losing entrepreneurs. I think that fear is now being shed. So I think it's okay. It's a good thing. Okay, now on your question on whether the market is priced in. See, I think I don't believe this is systemic, what's happening in NBFC. I think it's more idiosyncratic, which is, and again, in hindsight, it should not surprise us, because the whole sector grew its loan book at 30-40%. And this is a thing which I learned long time ago. When banks do 40% CAGR on loan book for 3 years in a row,
there's a problem.
You have to be worried, because you will inherit some bad loans, because the credit standards do drop when you're growing at that pace. Nobody is built for credit assessment to grow at that pace. It happened in 9, 10, 11 to the large Indian banks, and it happened in the last 3 years to some NBFCs. So I think the market is not worried. Actually, you can see that in the price action, not on the day, but a day or two later, how quickly the market comes back. So I think it's more or less priced in. If this becomes a bigger problem, then it may not be priced in.
So can I say that your pitch at this Morgan Stanley conference is that, look, we got unlucky because of demonetization. Then it was GST transmission, or GST implementation. Then it was IL&FS. Election, thankfully, we've been on the right sides of the event. So for the first time, there are chances that Indian earnings will get a clean year. We've not had a clean year for 3 years now.
Yeah, I think we're already getting there. So yeah, your last quarter should have been a clean quarter, but we got embroiled in this consumption slowdown. So maybe not this quarter, but the next quarter I think looks a lot cleaner. This quarter is still, settling in, because the election stuff is still there this quarter. Elections only got over at the end of May, so bulk of the quarter had to take that pain. I think the next quarter will be that clean quarter you're referring to. That's not necessarily my pitch at this summit. I don't have a pitch actually. What we have is a lot of investors and a lot of interest in India, which doesn't surprise me. As I said at the outset, we get a lot of calls wrong, but we do get some right as well. And one of the things that we went right on was we predicted that foreign investors will come back in size in 2019, and they are coming back. And it was based on the fact that their positioning in India was very light. And it just required a little bit of better performance from India, to attract foreign flows. So that's what's happening. India is on a relative basis looking a whole lot better than the rest of the world. Now, we didn't discuss that in great detail, but the relative case for India is looking quite good. In fact, even the relative valuations are not that demanding right now. If you look
after the correction.
Yes, if you look at it on a price to book basis. So there is a fair bit of foreign interest, and I think investors are searching for the stocks that they want to buy, and that's really what we want to be focused on, rather than just purely the macro thing. The macro thing also is part of it, but the companies and the stocks is really where the engagement happens. Now, I asked my desk to count, and they spent an hour counting. There are 3,000 interactions happening over the next 3 days.
That's a record number.
Yeah, between 450 investors and 90 companies that are coming to our summit. It's a staggering number of interactions, spread over 3 days. So something has to come out of this, but I'm very excited to see what comes out of all this.
One thing I look forward to when I interact with this Morgan Stanley conference is that we speak about mega trends. Last time you spoke about 3-4 mega trends: electric cars, inflation permanently coming down. That was last year's conversation. What are the mega trends according to you now?
So I think two things. Okay, one is at the company level. I think it is company 2.0. Take the name of the company that you want. Okay, a lot of C-level people are coming to this summit to explain how their businesses are transitioning. mostly by choice, but sometimes by force. The external environment forces you. Like the external environment will force the auto companies to change because regulations will make electric a reality, right? And therefore they'll have to change. Other companies are making their own choice because the marketplace is changing. So I think company 2.0, investors need to be very careful. Companies that are not changing their business models may get
chopped out completely.
Yeah, they will just lose in this environment. And the second is the ongoing theme of disruption. So a lot of things happening there, disruptive technologies. I have my European industrials analyst who has penned an essay on second machine age and how manufacturing will change. It's reminiscent of the late 19th century when alternating current became a reality. A lot of factories were not designed for AC electricity, alternating current, and a lot of factories chose not to revamp their factories. It was very painful.
Those were Edison fans.
Yeah, no, so those factories went out of business. Those who took that pain and remodeled their factories were the ones that survived. So we are in a similar situation with respect to robotics, with respect to artificial intelligence. All these things are coming to the fore. So there's disruption happening there. Electric is about to start. Yes, we discussed it last year, but it's now, it's going to start now. So there's disruption happening there. So there's a fair bit of disruption themes that are embedded in this summit as well. So two things, corporate 2.0 and disruption.
One fact of the life is that in India, only big are getting bigger. When I started my career, there were 20 IT companies. There were 3 large IT companies. There were 3 large IT companies still exist. The 20 IT companies only, they've only become smaller. We've seen that happening in consumption. We've seen that happening in autos. So large will become bigger and big will become mega. Is that underlying theme for next 4-5 years? Just focus on large caps. Don't try to do cute picking in mid caps and small caps.
Just a word of caution, Nikunj, is that who becomes large is not known to us. Okay. Yeah. Large does become mega, but who becomes mega? And as a simple exercise, go back to 1993 and pen down the Sensex constituents. And then roll forward 25 years and now pen down the Sensex constituents and find the overlap. I'll tell you the overlap, it's 5 companies.
Tata Steel, Indian Hotels.
25 of them ceased to, 25 of them, most of them ceased to exist. They don't exist anymore. It's not that they've become smaller, they just shut down. So the problem here is about finding out which one will make up. Of course there will be mega companies and then there will always be small companies. A lot of those companies that were not in the Sensex were small companies. They became big. So it's always a mixed bag. I wouldn't pass a sweeping judgment on currently large companies and say, oh yeah, they're all set to become mega. I think some of them will fall by the wayside.
Okay, just a couple of last follow-up questions, 2 more. And one, I just want to go back to this entire global big picture. 3 markets, bonds, commodities and equity. All of them are telling you perhaps a different story. The 10-year paper is at a multi-month low. Oil prices have come down. So commodity and bond market are telling you that a slowdown or recession is coming. Equity markets are telling you that a growth cycle is about to start, or growth will be strong. Who's going to get it right, equity or bond?
So you're referring to the US
markets.
Yeah. So our US call is that there's a slowdown in the world led by the US that explains falling yields and stagnant commodity prices, and therefore our view is that the SPX is going to struggle.
If US struggles, what it means for us?
So that's okay. We've had a situation where we have decoupled in the past. India's beta to the world is at all-time lows. It's around 0.6. India is like a consumer staple stock in the world. It'll actually do quite okay. Absolute returns may be a problem. I mean, can we generate an absolute upside to the Nifty if the SPX goes down 10%? Difficult. But can we outperform? Yes. So for global investors, India is a good choice to make. For the rest of this year and maybe even next year. Local investors, need to be careful, because if the world does, kind of fall off the cliff, then the Nifty will struggle.
You've been tracking markets for almost 3 decades now. If you have to reflect back at Ridham Desai the investor and Ridham Desai the strategist, how would you reflect differently? They both are different, right?
I think I've done slightly better as an investor than as a strategist.
What's been the biggest learning for Ridham Desai the strategist?
Yeah, what's been my biggest learning? Wow, you should have asked me this, you should have warned me of this question. Yeah, don't take me seriously.
So forecasting is a dim business, but you love the business.
It's very entertaining.
Appreciate your time, have fun at the conference.